This is an escrow or an impound account, and essentially what this is this is the account that the lender uses to collect and hold your real estate taxes and your homeowner's insurance if you pay those as a part of your monthly mortgage payment. And so this is a highly regulated account. Okay, lenders are only allowed to hold so much as will not allow their cushion to drop below 2 months. So they're allowed to have a 2-month cushion. And every year they have to do an annual audit with that. Basically they send you a statement that says, okay, here's where we are. Here's where we're projected to be in the next year, given what we know about your taxes, what we know about your insurance, what your balance is right now, and here's what we need to do about it. And what they need to do about it is either refund you the excess. So if they come upon that annual audit where they're reviewing the account, and they're showing that projecting the next year forward, if they start with the existing balance in your escrow account and just continue collecting what they're collecting and make the projected taxes and insurance payment, that they're going to end up with a minimum balance over the course of that 12 months. The lowest balance exceeds 2 times your monthly escrow amount, then they're collecting too much and they have to refund that to you. Now, conversely, what more often in my experience happens is you end up with a deficiency because taxes went up or homeowners insurance went up. And if you have a deficiency, generally you have 2 options, and these are protected. You have 2 options, and the lender will offer these options to you. They can either collect it all at once, so they can project that forward balance and say, look, here's the projection of the year going forward, and look, at this point in time, whatever month it is, in April of 2024, after we make your tax payment, we're actually going to have a balance that's below 2 times the monthly. And so we have a deficiency. You can either pay that to us now in a lump sum, and then we will adjust your payment going forward based upon what the projected balances are without that deficiency factored in, because you've paid that in a lump sum. You have restored that deficiency, or you can pay it over time. We'll just take that deficiency, divide it by 12, add it to your monthly payment, and pay that over time. And so most people kind of default into that latter method just because it's just kind of the easier thing to fall into, and that's what the lenders default to. But let me just kind of show you how this works. In this particular case, this borrower had a surplus. So you see here, this escrow account had a surplus. And let me show you how they came to that. So first of all, expected to pay. And so what they had here is they're showing, look, here's what the prior year was, for insurance. And you see this is insurance and taxes. They're both escrowed. And this is what the previous year's impound was based upon. And any analysis should give you this information. We showed you, we expected $31.97 at the beginning of this year and $7,113 in county taxes for a total of $10,310. And now they're saying now what we expect to pay. And what does that mean, now what we expect to pay? Well, they have to review this annually. So let's say, this statement's dated May 10th of 2023. So let's say they bought the house in May of 2022. And so this is a full year hence. And of course, homeowners insurance in this case went up significantly, went up from $31.97 to $39.24. So homeowners insurance went up, but taxes went down. In this case, they went from $7,113 to $59.51. And so over the course of the year, what's projected out into the future, and these amounts are what's projected into the future. This is what they're going to base the coming year numbers on. And we'll look at a detailed analysis of this so you can get a sense of how that works. But what they're saying here is they say, okay, we've got a surplus. So there's no question of spreading that surplus over 12 months. The lenders will never do that. I don't think they have the legal right to do that. They have to refund that to you because they're holding, in fact, I know they don't have that. They're holding too much of your money, so they have to refund that to you. And so this case, they're going to just send a check automatically out to you of that excess, and then they're going to roll forward. But your new payment, they've adjusted, they're going to say it was $31.56 with your principal and interest in escrow, and now it went down to $29.96. Now notice, principal and interest stayed the exact same, and that's normally the case. If you got a 30-year fixed rate mortgage, that's going to stay the same. But what did change is your escrow portion of this payment went down. And again, this can go down or it can go up. It just depends on what's happening with your actual taxes and insurance. So let's go to that next section. And what we'll see here is they're kind of telling you right here, here's what your new required minimum balance is. And that's the minimum balance at the beginning of the period. So they're saying, look, this is the required minimum balance at the very beginning of this next year looking ahead. And that's what these accounts do. They start with what's the balance we need today, so that if we project this out for another year and we show that we're collecting, and in this case it's the $822.93 a month, we're adding that every month to your escrow account, and then we make your tax payment and your insurance payments. What is the amount we need to start with right now, such that our minimum balance over the course of the year will exactly equal 2 times this $822.93. So let's go to the next page. So we go to the next page. So first of all, here, just want to be clear, notice these dates, these are all in 22. They're showing you here what happened last year. So they started when they took this loan out with a $2843.86 balance, and they're just projecting it through the course of the whole year. They're saying, okay, we have a escrow balance, we have a projected and an actual, and we got to the, they're just taking, this is actual through the course of the whole year. Now look, they're highlighting, they're saying, look, this was different than what we expected. Now in this first case, it was off by a few pennies, no big deal, right? But in this latter case, real estate taxes actually went down, but this is showing what actually happened over the course of the last year. They actually added this amount every month, they actually added this amount every month, and then they took away these amounts, and here's the balance they ended up with, $1692.33, and that was June of 2023. And so, there you see here that they're actually saying this is the estimate. They're projecting this forward because there's time, obviously, to get the statement to you in transit. So they're saying, look, this is what we're projecting. We're projecting after you make your next monthly payment. Remember, this statement came in May, so they're projecting one more payment forward before they deal with all this with you, because it gives you time to receive this notice and make your decisions. And they're projecting that they're going to have a $1692.23 balance. Well, remember, the required minimum balance is $1645.87, and that's where this $46.32 escrow surplus came from. Now, how did they come up with this new required minimum balance of $1645.87? Well, you'll see this next page. It's going to look very much like this page that we're about to turn off of, with the big difference is that now we're starting here and we're going forward the next year. So we're going to project forward the next year. So let's see what happens when we do that. So remember, we have the $1692.23 balance, but now we have refunded a portion of it, so we've reset our beginning balance to $1645.91 because they determined that's what was necessary. Now notice, if you took this $822.93 times 2, what's that going to be? $1,646 roughly. And if you look at this, that is actually the very first payment at the very beginning of the year. After, that's when they actually hit that minimum balance, is at the very beginning. That's not always the case. Sometimes it happens anywhere down the year. But the point of this thing is to show that if they start with this, that's actually the lowest balance they'll have all year, and that is actually 2 times the monthly amount, and that's what they need in order to make sure that they never go below that. If they took a penny less than this as the starting balance, then their starting balance would be a penny less than the minimum that they're allowed to have, and they want to have that minimum. But this just basically then shows you what your balance is going forward, and it shows you that they're projecting again at the end of this period $1645.87, and this is just proving out how they came up with that required minimum balance was. They ran it through the next year. Remember, all these dates are in 23 and 24 now because they're rolling forward to the next year. And they're just showing you this is how we came up with the $1645.91. And actually, I think I misspoke on that because the minimum balance they came up with was $1645.87. And that balance is actually achieved when they make that homeowners insurance renewal payment at the very end of this 12-month look forward. So at the very end of it, they make this payment, and it does in fact end up with a balance of $1645.87. And this $1645.91 is exactly what they need to start with in order to make sure that that balance never drops below that. So that's what that is there. I hope that helps out and makes sense. If you have any questions, let me know. Of course, please do like, subscribe, and ask me any questions you want. Give me a call if I can help in any way. And thanks again for listening. Take care.